Hey gang, welcome back. Good to see you again. For those of you showing up for the first time, I am the Articulate Grunt. Welcome to my Wednesday, 13 June show. Sorry about missing yesterday, guys. Tuesdays are normally a little crazy and hectic at work, and yesterday was just insane. So, let's go down to what we're here for. A little bit of news and notification. If you don't know who Moody's is a Wall Street credit rating agency. They're the ones that, if you remember back about a year, reduced America's credit rating from like A+ to A and caused all sorts of, commotion and panic that I don't think has really come down to actually being noticeable by, the common man, you and me. Well, Moody's is doing their job again and is looking at reducing the credit rating of 17 major international financial institutions. What do I mean by this? Well, institutions such as Chase Morgan, Bank of America, are two of the 17 being looked at for a reduction in credit rating. What this means for them is that here in the U.S. and possibly in other countries, they've got to deposit for securities in the national reserves a larger quantity of their cash on hand. Now, this doesn't mean that the money in the tills, the money available when you go to cash your paycheck is going to be reduced. No, all that's going to be covered. They've got plenty. What it does mean, though, is for those people looking to start a business, those people needing a loan, whose credit rating is on the cusp of whether or not they might get that loan, it'll make it just a tiny bit tougher because there's less funds available. In addition, myself, I've got a bank account with Bank of America. I know a lot of people went to credit unions, but a lot of people are still with the big banks, the big financial institutions. What this does mean is that you may want to keep a watch and see over the next few months if they try to raise rates or change policies. Because typically, historically, when they've got to take a large chunk of their available capital and deposit it, they like to rebuild that. And okay, instead of 10%, they've got to keep 12% on deposit. Or they like to raise their overall capital so to still have the financial liquid assets to cover down on what got deposited. Now, of course, they raise their overall amount of liquid capital. That means they've got to deposit a little more, but they try and create an extra surplus, thus compensating for what they've had to deposit. How can banks do this? Normally, increasing fees and interest rates. You might get a notice in the mail, which you might not take notice of if you don't pay attention, that bounce check fees are going from $15 to $20, from $30 to $32, or similar things. Interest, the fees and such you pay might take a slight increase. So keep your eyes open. That's going to be the big pieces we're going to want to watch. Personal suggestion, go online, look up your financial institution, reference them across with Moody's, M-O-O-D-Y, ''S, and see if they're one of the 17 that are being considered for financial review. If so, go ahead and look up, see what kind of chances it is they're going to have their credit rating reduced, and look up what that'll actually mean for the company, and thus most likely for you as the consumer. Unfortunately, things are still busy and crazy as heck. I gotta run. Leave me your comments down below. Hit the like or dislike button down below as well. Hit the subscribe if you want to. Take care of yourself. Keep your heads down. And I will see you next time. Take care.